If I give you $1 million right now, tell me how and where would you invest it? Think about diversification, inflation, risk, growth, everything before you answer. This is day 2 of Investing 101. If you haven't watched day 1 of this series, watch it here. In the first video, we talked about why you should invest, what is the compounding effect, and this thing called as inflation. In this video, we will dive deeper into all the investment options that we have and how to make a great portfolio. So that brings us to the first option that we have, which is debt. You have 3 major options in debt, which is government bonds, corporate bonds, and fixed deposits. Let's talk about the first one, which is government bonds. What exactly are these? You basically are giving some debt to the government, and in return, they are giving you the interest. As simple as that. The interest that you can expect here is around 6 to 8%. Don't quote me on that. It changes based on the market, based on interest rates. But generally, you can expect an interest rate of 6 to 8% if you invest in government bonds. And the other thing is they're very safe because you're giving debt to government. They won't default. Probably they won't default. So your money is comparatively in a safer position. So you can gain 6 to 8% and it's almost kind of risk-free. The second option that we have is corporate bonds. Now, in the first option, you are giving debt to the government. In this option, you're giving debt to the corporates. So basically, there's a bit more risk because you consider government as the most safest option. Corporates can default sometimes, even government can. But anyway, let's think corporates can sometimes. Even then, it's almost safe. Here, you can expect a return of 7 to 9%. Again, varies based on the market interest, but you can expect a return of almost 7 to 9% if you invest in corporate bonds. It's again almost safe, almost risk-free, but again, no major growth happening here. The third option, which is the hot favorite of every Indian family, which is fixed deposits. I'm pretty sure your money would be locked in some fixed deposits because that's what we generally do all the time. It's one of the safest option, the easiest option, and I think we are very comfortable doing FDs in India at least. So here, the return that you can expect is generally 5 to 7%. Again, it varies based on interest rate, but this is on average, you can expect 5 to 7% in FDs. Now, this is overall the options that you have within debt. Why you should consider debt? 2 major reasons. First thing is income stability. If you invest in debt, be it government bonds, corporate bonds, or FDs, you have income stability. You have a fixed rate of return, almost fixed rate of return, 5 to 9%. It's not fluctuating like 1 year you're not getting 10, then 20, then minus 10. It's not happening like that. It's a very stable source of income. So you'll get 5 to 9% year on year. So very safe. Second great thing about this is risk-free, almost risk-free. So I can't say nothing is 100% risk-free, but almost debt is almost risk-free. So your money is comparatively in a safe place. You don't have to worry much about it. Now the problem with debt, it is the rate of return, what we just discussed, 5 to 7 or 6 to 8 or 7 to 9. This is almost just barely beating inflation. In the first video, we talked about inflation, the inflation rate in India as well. So essentially, if you're getting this rate of interest, you're not creating wealth in real terms. You are just barely beating inflation. So this overall covers our debt, the reasons why you should invest in debt and the problems with debt. I'm not saying it's a bad thing to invest. You should always have some emergency money in debt so that you can always use it when there's some kind of emergency. But don't put a lot of money here because you're not growing money actually here. The second option that we have here is gold. Again, hot favorite. Almost every household in India, they would have some form of gold, be it digital gold, be it in the form of jewelry, or maybe a lot of other options, but definitely everyone has gold because again it's very popular and we love gold, especially in terms of jewelry. If you want to invest in gold, there are 3 major options. There are a couple of other options as well, but 3 major options that you can have. First one is physical gold. Obviously you can have in form of jewelry and stuff like that. That's the first option. The second option that you have is digital gold. You can have gold ETFs, digital gold, couple of other options there as well. Third, new option which is called SGB, sovereign gold bonds. A very interesting one to be honest. Now let's talk about each of them one by one. First option that we have is physical gold. The biggest problem with physical gold I feel is storage. Where you store it, you'll have to keep it safe, you'll have to take some bank locker, you'll have to keep it safe there. And if you're using it in the form of jewelry, then obviously you're making charges, which is almost like 10, 15, 20%. So a lot of money is getting wasted there in terms of making charges, in terms of storage, in terms of safety. So not a great option there. But the return you can expect here is 8 to 10%. Gold generally the last 10, 15, 20 years has given an average rate of interest. Average rate of return is almost 8 to 10%. So this is what you can expect if you invest in gold. The second option there is digital gold, which is a bit better than this physical gold because you are not owning physically, so you don't have to store it somewhere, keep it safe. You don't have to do that. All you have is it in a digital format. You have your demat account. It is you buy some gold ETF or something. So it's in a digital format. So it's comparatively very safe. You don't have to pay for the making charges, the storage, and the safety and all that nonsense. So again, the return would still be the same because it's still linked to gold. So either you buy it physically or digitally, your return would remain the same. So again here 8 to 10%, that is what you can expect even if you buy it digitally. A good option, to be honest, much better than physical gold. The third option there is SGB, which is called as sovereign gold bonds. This is a really interesting option. In fact, I would make a separate video on this, a new scheme by the government, and it's an amazing option if you want to invest in gold. Couple of things here. It is a paper asset. No physical gold is being traded if you buy SGB. It's a paper asset, but since it is RBI backed, so it's very safe. The great part about SGB is it gives you 2.5% simple interest year on year, so you have kind of almost regular income from it. Plus if you keep it for like 8 years, then you get indexation benefits, but you pay zero tax. So that's amazing part. I'll make a separate video for this, but that's about SGB. Now, so these are 3 options if you want to invest in gold. So why should invest in gold? 2 major reasons. First is almost no risk. Almost no risk. Because the first thing is gold is indestructible. It is not as if you can print infinite amount of gold just like you print money. So you can't do that. So obviously it retains its value. So gold is pretty safe, pretty risk free. So that is the great part about gold. Second thing is it is great in terms of economic uncertainty. Whenever there is economic uncertainty, gold shines. It's a great hedge against inflation. Even if your country is not performing well, and if you're owning gold, that basically means you are not losing your wealth. You're still retaining it in form of gold because you can go to any other country and you can use that. So basically just saving yourself from the inflation as well. So again, a great option there. Why you should not buy a lot of gold? A couple of reasons here again. If you buy in physical format, then obviously you'll have to keep storage, making charges, safety, all those concerns. But if you don't do that, if you go to a digital format, that's a bit better. But the problem there is it does not generate regular income. Unlike FDs or bonds or a couple of other options that you have, it does not do that. You have to completely sell it to own that profit. Now SGBs are kind of changing that, which is a great thing about SGBs. But majorly you can't have a regular income from gold. So that's about gold. Now, third option that we have here is real estate. I'm pretty sure almost again everyone would have some form of real estate if you are owning a lot of money. Otherwise it's difficult to get into real estate. But majorly you have 2 options if you want to get into real estate. The first option is a residential property. The other option is a commercial property. Now, let's talk about each one of them. If you talk about residential property, these are the properties where these are basically like your apartments, your houses, your villas, basically used for residential purposes. Now, since somebody is living in these buildings or in these spaces, you can't expect this crazy amount of return. It is comparatively less than a commercial property. What you can expect here is 6 to 10%. This is the average rate of return. But don't quote me on this because real estate is a hyper-local game and it can change drastically based on where you would have invested your money. You might have bought an apartment and you got something, I don't know, some golf course nearby or something else nearby, so your property appreciated by like 100%, but there are chances it could appreciate way less than that. On average, you can assume that you will grow your residential property at like 6 to 10%. That's the average that you can think of, unless you have got a crazy or a really interesting deal where you're growing it more than that, which is quite possible to be honest in real estate. It's a hyper-local game. The second option here is commercial real estate. Now, commercial real estate, as the name says, they are used for commercial purposes. Where you're buying something and giving it to someone for commercial activity. For example, you're giving out a complex to a brand that is doing some business there, or you're renting it out to someone else, some other business. Now, since some business is being done here, some profit is being made, so you can assume a bit more return. So in a commercial property, you can assume 8 to 10% maybe return, almost like, or maybe even 8 to 12% sometimes based on the property that you have, that you can expect in a commercial property a return. Now, why should you invest in real estate? Again, two major options. The first great thing about real estate is it gives you a regular rental income. That gives you a lot of stability, literally a lot of stability. Imagine you were owning a flat or anything in any city in India, and you own that for almost like 1 crore. If I talk about Delhi NCR, then if you have a flat that costed you 1 crore, almost you'll have a rental income of 4 lakhs year on year. So again, gives a great safety net. You have a regular rental income that you can use to, for your expenses. So again, a great source in that aspect. You have a regular rental income. The second great thing is property appreciation. You're getting regular income. Along with that, if the property is really nice, and I won't recommend apartment because of this reason, because they generally don't appreciate much. If you own land, if you own a villa or something like that, then the property appreciation would also be pretty high. So you're getting rental income. Along with that, you're also getting a great property appreciation. That's pretty amazing, right? So in that case, it's pretty nice in terms of when you want to invest in real estate. The problem with real estate, the first and the biggest problem is the huge ticket size. When you want to buy in, let's say you want to buy gold, you want to buy corporate bond, you want to get into FDs, you can invest 1,000, 5,000, 10,000. You can't do that in real estate. Almost you'll have to start with at least 50 lakhs, 1 crore, something of that range to get into a decent deal, and it goes way higher than that. So it's a really high upfront cost. So it's not very easy to get into real estate. Plus, Indian real estate is also kind of black box. A lot of scams happen here. So I would literally suggest you to stay away until you are absolutely sure about what you're buying. That's again a problem with real estate. I think that's the only problem. But it beats the inflation. You can actually become wealthy using real estate, because on a longer term horizon, at times properties give a huge breakout and you have a lot of money. That's one possibility. I want to talk about two more options also in this video, but I think the video would get a bit too long, so maybe I'll just talk about those two options, which is equity and cryptocurrencies, in part 2 of this video. So for now, let's just summarize this video. So we basically talked about 3 major options where you can invest. The first was debt. Within debt, we had corporate bond, government bond, and FDs, where you can expect a return of almost 5 to 9%. Problem? You're not beating inflation, almost like barely beating inflation, not growing your wealth, but very safe. That's the first option. The second option we discussed was gold. Again, kind of is a great hedge against inflation. So that's a great part about gold. The problems, if you are owning it physically, then where you store it, the safety and all those making charges and all that nonsense. So that is with gold. But again, a great part when it is economic uncertainty, that's about gold. Expect a return of 8 to 10% when you are investing in gold on a longer term horizon. Third option we discussed was real estate. A great thing to own, but has literally high upfront cost. It's not easy to get in. Plus a lot of scams happen. So have to be really careful when you buy real estate. That's the second thing. But you have good rental income, plus you have property appreciation. That's a great part. So I think that summarizes all the options we discussed. Now, if you're just starting out on your investment journey, what I would recommend? I would say learn about debt first. Build your emergency fund. That's extremely important. Before even thinking about growth, have some emergency fund that would be used when you actually have a problem, when you actually need money. So understand FDs, understand bonds, and invest some amount of money in these and just lock it. You're not even thinking about growth, you are thinking at literally emergency fund. You would need it when there's a problem. So keep that, lock that money in some FDs or some bonds. That's the first part. Second thing, learn about gold. When there's economic uncertainty, there's some problem, gold would literally shine and help you retain your wealth. So again, invest some amount of money in gold so that you retain your wealth. Again, here I would recommend SGB. I'll make a separate video. Please watch that. It will give you a complete understanding of how to invest in SGB and why you should invest in SGB. But I would not recommend physical gold again because of those making charges and all that nonsense. So ideally, own SGB or digital gold. I'll make a separate video for that. That's the second thing you should have. Third, I would recommend is mutual funds. People say there's a lot of risk, but there is not actually a lot of risk. If you see a longer term horizon, I'll make a separate video for that. You'll understand more about it. But that's the third thing you should learn. Once you do all of this, Then the next part should be, if you let's say now understand about equity, you understand about debt, you have the emergency fund, now you want to grow your money, then understand more about stocks. Pick good companies, pick good stocks and grow your wealth. That's the other option. And then if you are even advanced, then you can actually go ahead and go with future and options trading and stuff like that. Even cryptocurrencies, you can go in that direction. Again, to have more risk, but again, high risk, high reward game there. So that's how you should build your portfolio. The first question I asked in the beginning, where you had to invest $1 million, keep holding on to that answer. I'm going to discuss the other two options in part 2. So then tell me, how have you changed? Or maybe you can just tell me right now how you're just thinking again when you want to invest that money, considering risk and reward at the same time. Stay tuned for the second part of this video, where I'll talk extensively about equities. Within equities, I'll talk about mutual funds, stocks, and future and options, and cryptocurrencies, Bitcoin and Ethereum majorly. I hope you found this video informative. Stay tuned for the next video. Until then, keep investing in your dreams.